the stock market is a wealth compounder, and it is actually a great wealth compounder if you do it over a long term, right? So let's say, for instance, we are doing it for 10 years horizon right here. So in this video, we are going to simulate that using one of my calculator. And how do we make the best out of the stock market? So let's say, for instance, we all know the legendary investor Warren Buffett has made billions in his years of investing, and he's not even timing the market. And as of today, he's the top 5 wealthiest person in the world. So if you take a closer look in his portfolio, it's not always a smooth ride upwards. And what we can see here in his in his net worth, you could see in the years of let's say around 5 years, you could see there's a ups and downs, right? But every time it goes down, the portfolio goes down, then and some years later, then it goes up exponentially. All right, so he's looking at a long-term horizon right here. You can see that there's a huge, if he's even he's making billions right here, he doesn't find too much challenges compounding his wealth, because actually the bigger the bigger the fund you have to manage, the more challenging you have to look for volumes or liquidity in the market that could offer to you, because the market is the market has to have enough liquidity for you to actually accumulate such an amount, right? So you notice that in his if you see, it's not amounting to like a 10 or 20 billion, right? So you can see this ride is smoother upwards. But when it reaches up to like a 20-30 billion, then it struggles a little bit on the portfolio. So of course, when we look at Berkshire Hathaway, this it has always been outperforming the S&P for a long period of time. So now this is the past 20 years performance. It has been like a 3 times beating the S&P. And of course, this is one in one of my previous videos that I've asked most of the audiences, can we even beat Warren Buffett? Now, we actually small investors, right? So we don't actually have, the portfolio amount up to 100 million. So we do not have liquidity problem, and we could actually be more flexible, and we are like a speedboat. So Berkshire Hathaway is like a big ship, so like a Titanic ship. So when it bends, when it turns right, it takes a longer time. So speedboat can make sharper turns, and that means we can actually consolidate, or we can actually buy stocks, great stocks, which actually belongs to the less than 1% in the stock market, are actually great stocks. So let's say, imagine you have a big circle right here. In US markets, there are more than 8,000 stocks listed. So we are looking at less than 50 stocks here. So we are actually investing in our circle of competence, what we can say. So those less than 1% stocks, most of them are actually dominant stocks, dominant businesses, and they have characteristics of brand monopoly or duopoly. So like stocks like Microsoft, Amazon, Google, and Facebook, or even Apple, so they do actually have characteristics of brand monopoly. So you can see that they in a 10 years performance, it has beaten the S&P like around 4 times, right? So, oh sorry, even beaten. This is Berkshire Hathaway. Beaten Berkshire Hathaway about 4 times, right? Between yeah. So okay, there's a big separation there, and we know if just now what we saw was an average performance of the like 5 stocks, great stocks put together, and this is the accumulation. So let's say, for instance, if we put together all these 5 stocks, and let's say if we have invested about 50,000 in year 2010. All right, in year 2010, of course, in 2011 we don't see much gains here. Maybe we see 53,000 the year onwards, and Facebook is only listed about 2012. And the year after 2012, you can see that it has actually doubled after that. So of course, with all this add together, this 50,000 without timing the markets, it could reach up to 574,000, which is about 1,100% gain, or you could say that's 11 times gain. So without even timing the markets, right? So right here, if you want to be a little more detailed, then you could actually look into some bar charts that we have breakdowns of different companies. Like here, you have like Facebook, Microsoft, Google, Amazon, and Apple. All of them breakdowns in this chart right here. So you can see actually in the entire growth here is that you can see Amazon is one of the biggest catalysts or the biggest contributor right here. All right. So okay, now it's not just Facebook, Amazon, and what about the rest like Mastercard, Boeing, McD, Autodesk? So most of them, if you take a snapshot of these monopoly characteristic stocks, and they do actually have a compounding effect, so compounding the returns. So how about we simulate this in a wealth simulator or calculator? So let's say we go to the Excel format, and what I've done is that I've taken about 10 years horizon. So right here, 10 years, and I've simulated two methods of investing. One is passive, without timing the markets right here, and the other one is active investing, where you could time the markets, and also you might do some intrinsic value calculation by qualifying the stocks. So you can see that there's a 10 years horizon that I've actually simulated, and what we can see here is okay, if you take a look here, the starting capital, let's say 10,000 US dollar, or if it's Malaysian, if you are Malaysian, then you talk about Malaysian ringgit, 10,000 Malaysian ringgit. So let's say every month you get to save about 2,000 US dollar, all right, or 2,000 ringgit. So, and right here is actually simulated inside every month. It's about 2,000 savings. So compared to the savings, cumulative savings, that is actually not invested. So of course you know that if someone is not investing, you can see it's like this performance here, the yellow color area. So it's quite linear, right? So if we look at an active, I mean a passive investor, they have about they make between 25 to 45% gains per year, and this is for the stock pick gains, but actual capital gains, of course, the first year is a lot, and because we're saving along the way while we're having stock pick gains, so this will actually show a lot more right here. So if we are talking about active investing, a trader could actually or an investor could actually make up to even 70% gains per year. But of course, there will be some flat years like this. All right. So generally about between 30 and 70% per year. But I'm being a bit more conservative right here. Let's not go too far on that. So we just do three comparisons right here. So well, if this is too difficult to compare, then we will go to okay bar charts, which is easier to actually visualize. So okay, right here, what we can see here. Okay, you can see a 10 years horizon right here, a 10 years horizon, but let's look at the 5 years, a shorter horizon here. And in the beginning, you don't see much difference. So see, there's not significant difference until you see the fourth and the fifth year. The green color is passive investing, and the red color is active investing. You can see even sometimes active investing, because of timing the markets, it can be actually underperforming the passive investment. All right. Let's say, for instance, this is just a simulation and it's just an estimation. Then somewhere along the road, if the active investor gets better at timing the markets, then it could outperform the passive investor. So now let's look at the long-term view right here. Is that okay? So now you can see that the yellow color bar, it caps, it goes up to 250,000 in year 10. But if it's a passive investor, then it could go up to about 1.2 million. That's about like 4 or 5 times more, actually, well built over time. So active investors, they could actually even use options instruments, and they could, do some trading, or even using the seasonalities to time the markets or buy the dips. So they could actually have better gains over a long period of time compared to passive investors. All right, but they have to be very well equipped with price action also as well. So okay, so that concludes the simulation that I've done. But if anyone wants to enter a different lab value on this, that I could share this Excel sheet. So this would be like a random numbers. You could see the equity curves are not a straight line. It's generated with like losses and gains along the way. Right. So now let's go back to this slide. So this is what we saw, ups and downs. Yes, but over a long period of time, you still have to. You still get the exposure of exponential gains in your equity curve. So there's another way to look at it. And let's say, for instance, you're a type that says that I'll just put like 2,000, 3,000 every month in the market in the first place. You would want to save up to 100,000 before you put into the stock market. All right, so it might take you up to 4 years to save up to 100,000 right here. Then this is where you want to invest your money, let's say, for instance. And let's say it's been compounding maybe about 20, between 25 and 35% per year. So the next 100,000 mark would actually be shortened to 3 years instead of 4 years. So as we know that our wealth is compounding, then let's say every month it's actually $2,000 saved, and you only need 3 years instead of 4 years, right? So then the next 100,000 would take about less than, okay, it will be 2 years, around 2 years, and the next 100,000 will be 1 year. So as time passes, then for you to make the next 100,000, it will be shorter and shorter amount of time. So you see, this stretch here takes you a long time because you're not invested. So if you're invested, then you could see the curve slowly become sharper and sharper, and the next 100,000 keeps becoming closer and closer in time. You can see that closer and closer. So this is another way to look at it as an investor. So it keeps people more motivated. Of course, yeah, next 700,000 becomes closer and closer. All right. So the time is actually works in your favor, as you're staying invested in the greatest businesses that's offered in the stock market. So okay, it won't take that long here. So always keep in mind, the more your money works for you, the less you have to work for money. Right, so thank you for your time and happy trading. Signing off, Striker X here.